Markets were not in for a surprise. The FOMC meeting left the base rate unchanged, leaving room for a slightly extended period of accommodative policy. But how long would this be? The language of the Fed statement is more reflective of the thinking of the majority at the FOMC meeting. The tone is more hawkish this time, and with each meeting, it has been turning more and more hawkish. This indicates the impending change in the policy in the not-so-distant future. The Fed chairman in his recent Jackson Hole speech said that substantial further progress test has been met for inflation and that there has also been a clear progress towards maximum employment. The present FOMC statement reads like this. If progress continues broadly as expected, the committee judges that a moderation in the pace of asset purchases may soon be warranted. If strength in growth numbers shows some consistency coupled with robust employment numbers, the bond buying may get truncated as soon as the first quarter of the calendar year 2022, with an emphatic indication coming from the November meeting of the FOMC. The reduction in bond buying would have an impact on system-wide liquidity and may result in a negative reaction, but the liquidity withdrawal alone may not have much bearing on asset markets. The critical factor is the change in the stance and subsequently the market expectations aligning towards the follow-up policy action, which is a rate hike. The growth projection has been lowered, whereas inflation is seen moving at a higher rate in 2021. The trajectory of growth and inflation ultimately decides the course of central bank policy. At this juncture, inflation gains more import as the policy is based on the premise that current trend of higher inflation is transitory. If the inflationary pressures turn out to be more structural, the policy response may have an adverse impact on asset markets.